This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Yes, indeed. Carol Massar, Tim Stenivek, live here at Bloomberg headquarters in New York City. It is Tuesday, May 19th, and I feel like we're becoming a little bit of a broken record where we see some pressure on equities as a result of rising yields. Although we should point out stocks are certainly off their worst levels of the session.
Yeah, off their worst levels of the session, but we're still seeing the S&P down 0.2%, the NASDAQ down 0.4%. On a day where we're seeing yields, Carol, move higher, the 30-year hitting levels last seen in 2007, boosting the odds that the Fed is going to raise interest rates.
Yeah, 519 is as high I've seen on that 30-year today. So, but you see it. And yet, equities off their worst levels, so willing to rebound. So we'll kind of get into why that's happening. Ahead this hour, we're going to get some different reads, in fact, on the macro environment. We are going to talk that higher yield environment, the market anxiety that creates, and how you look at fixed income versus the equity side of things. We're also going to talk kind of a deep dive into real assets.
Yeah, reads on the economy. Real estate with Brett Mufson, president and partner for the vertically integrated real estate and hospitality group Fontainebleau Development. Get an idea on what's happening in Vegas, too.
Yeah, looking forward to that. And then diamonds, even those grown in the lab. Nathalie Morrison is the founder of Astrea London. So she's working with Sarah Jessica Parker, and they are doing these lab-grown diamonds. So we're going to see
They're
what
all the rage with people getting engaged now.
You go into a jewelry store, there's diamonds, there's lab-growns, there's CZ, and then there's something else in between. There's like all these different layers. So
I just want to know, why wasn't this a thing when I got engaged?
I know. So it's very true. Anyway, we're going to talk to her about the demand and what they're working on. First up, though, let's get a check on that trade, because right now in the S&P, kind of an even amount up and down overall in that average. Charlie, take it away.
I will certainly do that. We are off session lows on the S&P 500 index. Dip buyers coming back into chipland this afternoon. Right now, the SOX up 1.4%. But the Dow, the S&P, NASDAQ, all moving lower. S&P right now down 17, 73.85 where we stand, down 0.2%. Dow Industrials down 104. That is a drop of 0.2%. The NASDAQ Composite Index down 93 for NASDAQ, a decline there of 0.4%. I mentioned the Philadelphia Stock Exchange Semiconductor Index. It is up by 1.4%. The 10-year, 4.64%. The 2-year, 4.09%, and the 30-year currently yielding 5.16%. Gold down 1.4%, 45.01 the ounce, while West Texas Intermediate crude oil currently trading 107.70 a barrel, down 0.9%. Barrel of Brent down 1.4% now, 110.47. Bitcoin down $76. Right now, Bitcoin 76,778. Bitcoin down by about 0.1%. Chip stocks have turned around, as I mentioned, by evidence of the SOX up 1.4%. NVIDIA up 0.4%. NVIDIA will be reporting tomorrow after the close of trading. Texas Instruments now up 1.4%. Micron up 5.8%. Advanced Micro Devices up 0.5%. Intel right now up by 3.6%. Bottom line here, stocks lower, semis higher, and the 10-year currently yielding 4.64%, with the 30-year 5.16%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. As you just heard from Charlie, we did see Wall Street's crowded shipmaker trade continue to unravel, dragging down stocks on speculation that a surge from this year's lows has gone too far amid war-fueled inflation risks that are boosting bond yields. Although I should point out, we have also seen the SOX go back into positive territory today. So
yeah, it's up 1.5% now, but at one point today it was extending this 3-day route.
Yeah, I think what's interesting is like investors are looking like this higher rate environment here to stay. What does it mean in terms of valuations, especially for some of those higher flyers, if you will, in the equity trade? You mean like the index
that's up more than 60% this year?
Exactly. Okay. What did I say? All in on the stocks. Okay. That's where I wanted to be. No, I did not do that. We've talked about the rising bond yields, how they are creating those problems for an expensive stock market. So let's jump into our market chat today. Great to have back with us Alli McCartney. She's private wealth advisor, managing director, wealth management with UBS Alignment Partners. They've got just about $1 billion in assets under management here in studio. And joining us on Zoom is our own Michael Mackenzie, Bloomberg News rates reporter. And we're going to get to Michael in just a moment. Got to talk about the rates environment. But Alli, I want to start with you. Stocks for a long time always seem to be looking for reasons to rally. I think it's even happening today, but it does feel like there's some more concern about this higher rate environment sticking around and what it means for valuations. Stocks was down earlier today, more than about 5% since May 11th. How do you see the market environment and then how higher rates play into it?
A lot in that question. So as you said, we've had 7 weeks of rally, right? We've had, it has been everything's rosy to the extent that we've looked through one of the largest geopolitical and energy issues in 20 years. And so I think what's happening now, although market participants seems to still want to ignore the Strait of Hormuz and the conflict or war, the question now has become about global rates policy and inflation and the link there and what does that mean for stocks. So that's what you're seeing, this back and forth. We now have a clear message that the next move in the UK and Europe from a rates perspective is up. We have the US markets predicting that the next rate is up. We think that it's down, but yields are telling a different story. And so this puts a pause in the rosiness after a market that I think has just from a valuation perspective incorporated the extraordinary earnings season.
Why do you think the next move is down, but the market thinks it's up?
So I think that what the market is not understanding or is not taking a look at is the labor market. And our labor market is this no hire, no fire. It's going to give at some point, whether it's from AI, whether it's pockets of high unemployment in geographies or in 20 to 30-year-olds. And I think that as we look at the combination of, first of all, like the fiscal spending that we have in this country that is really almost more than making up for, sadly, the crowding out that's happening from energy gains, and the fact that from a relative perspective, we are energy independent and our GDP is still growing. And what that usually means is, that there's still room, especially for a Fed that has maybe he's gotten a little more hawkish in terms of Warsh, has gotten a little more hawkish over the last few weeks in terms of the commentary. But I think the bias of that committee, and certainly his bias in the way he tells us he looks at things, is down, not up.
And let's not forget, we'll get some insight into Fed commentary and how they feel when we get the minutes from the latest Fed meeting. I believe that's on Wednesday. Hey, Michael, come on in, because we do want to get into the rate backdrop, the trouble that might bring for some of the high flyers in the equity trade. You've got a story on the Bloomberg talking about this surge in longer maturity U.S. Treasury yields testing the resolve of global bond investors, torn between the possibility of locking in the rates near the highest levels in decades and the risk of an even greater sell-off. What's your read on this? What are you hearing from the street? Is it any sign of the rates market basically topping out or not yet, or do we not really know? Michael, hang on a second. We've obviously got some audio problems there, and we're going to hopefully get to Michael, an important voice here for us at Bloomberg when it comes to rates. But I mean, you're talking about, what do you think from the Fed minutes? Does it matter what we get from that on Wednesday in terms of insight, or is NVIDIA earnings more important to you?
Yeah, so look, we're 95% through the earnings picture for the first quarter. We're trending at about 17%. We have two of the stocks, Micron and NVIDIA, will be a full third of that 17% earnings, right? So we still have that concentration, but we also have a lot of breadth. AI is in a new inning, in a new phase, and it is a new tailwind that is not just a tailwind to energy and hyperscalers, but to pharma, to healthcare, to financials. And so I think what we're going to have to do is we're going to have to parse from an equity market perspective the legs of the stool or the drivers that are interest rate sensitive, right? How much of our belief in this market and the valuations and the room for upside has to do with simply thinking that interest rates are going to be lower and the discount cost is lower, and how much is true growth, margin, increase in profitability, et cetera. And I think there is still a very important, impactful, and exponentially growing and widening AI story there about innovation and profitability.
All right. We want to bring in Michael. My understanding is everything's working. Michael, I want to ask you about rates. And I'm just, as you guys write, I think you heard me about your story that investors torn between the possibility of rates near their highest levels in decades and the risk of an even greater sell-off. I mean, do we really know what happens next? Or what are you seeing in terms of commentary and trades that maybe say to you things are headed higher from here?
I think, if you look at what's happened today, we've seen an enormous amount of selling block trades through Treasury futures, and that's really pushed yields to levels that has actually compelled people that bought Treasuries in the last week or two to cut those trades. And that's more of the fast money, algo trading, hedge fund community. If you talk to asset managers, you take the long-only, long-term view, there has been some buying going on. And they've been looking to scale in. But I think in general, the sentiment seems to be no one's really sure. We seem to be in a bit of a vacuum here, a bit of a pocket, because we're not going to get any serious data until the first week of June. We've got a long weekend coming up this weekend with Memorial Day. And the market is trading disorderly. It is, to quote a few people, it does feel a little unhinged, which is not a good sign. I think in general, the market has repriced the Fed. We're now seeing around 35 basis points of rate hikes priced in by the first quarter for next year. We're close to 20 basis points of a hike by the end of this year. A lot is going to rest on how Kevin Warsh and the Fed look at the data in early June, because this could continue to go. And I think some people are talking about that, the market needs to price in at least 50 basis points of hikes, given the inflation situation. And the fact that until the labour market shows signs of weakening materially, this economy is trundling along. It's got a good fiscal tailwind. AI is delivering very strong profit margins across the board for the S&P 500. So at the moment, the real story is that real yields are rising as well, and that tells you the economy is picking up.
Yeah, despite all of this, we have growth. It's sort of phenomenal, right? We have the corporate investor that continues to invest. They see a lot less uncertainty on the tariff front and on the regulatory front. We have the individual investor, which on the low end is certainly starting to cut in more to their savings and use credit cards more. But we have this economy where the top 10% spend 50%, right, and they've seen outsized gains in their portfolio. So my guess is that if we don't see a cut, as we expect to in the end of the year or now pushed into next year, that we're at neutral for a bit until we can see what happens. But I would be surprised, given the administration, given the bifurcation in the consumption market, and the growth that we're seeing, to see a hike out of this Fed.
Yeah, well, there's also the politics of it too.
Yes.
And the fact that if Warsh were to hike and that would be his first move, I think that would be a very different signal than the president actually wants to see. Michael Mackenzie, come on back in here, because when we talk about superlatives like the 30-year yield hitting the highest since 2007, people think back to what happened 2007, 2008, 2009. And I'm wondering, I'm not going to ask you why this time is different, but the signal is different. I think it's fair to say the economy is different. It's fair to say, but why are we seeing a similar move?
Well, if you think back to May, June of 2007, corporate credit was very, very tight. People had piled into corporate credit. The CDO machine was in full flight, and Treasury yields were rising, and everyone was focused on, okay, the Treasury market is sending us a signal. We don't know what that is. And ultimately, that broke the credit market. And it also broke the housing market, which, as we now know, was in a bubble. And if we look at today, we have very tight corporate credit spreads. We also have a housing market that is not going to be going anywhere with mortgage rates rising the way they're rising at the moment. And we do know that Treasury Secretary Bessent has made getting housing costs down in terms of mortgages a priority. That's not coming to fruition. So I suspect if we stay higher for longer, it is going to put increased pressure on corporate borrowing. It's going to put increased pressure on people taking out loans. Housing is an important driver of the U.S. economy. So we are very much living in very interesting times because this can go, again, the AI is helping the economy at the moment.
Yeah.
But again, how long is the consumer going to stay basically stay in here when, mortgage rates are going up, car loan costs will be going up? This is going to be tough to see whether the U.S. consumer can stay, and keep on trucking.
Michael, I'm going to come back to you in a moment because I'm curious when you say interesting, does that mean recession as part of interesting? But Alli, come on in. You're listening to Michael.
Everything he says is right. And that bifurcation between the people consuming in this country is clear and getting more and more exacerbated by the day.
I keep wondering when we're going to pay the piper for this because
For what?
For the bifurcation. We talk about this all the time. It's, for those who are in the market and dealing with asset gains or own a house that's going up.
Things are pretty good.
Things are pretty good. Mm-hmm. And then there's so many people we know where it's not the case.
It is absolutely a tale of two cities.
There's got to be consequences of that.
There have to be consequences. I think the longer term consequences, let's put the social ones, which are meaningful, to the side. But from a fiscal perspective, the consequences are clear that with all of the transfer payments and fiscal spending and intentionality and policy to try to alleviate that, especially ahead of midterm elections, that's just more and more debt, which in a sense complicates this issue. I think that a lot of the things that we referred to, whether we're talking about the Fed's next move, whether we're talking about waiting for the consumer, whether we're talking about credit markets, I think probably as he said, for the next month or so, certainly before potentially a big IPO that is, on the horizon that has some consequences, some of which are known and some of which are going to be unknown for markets and the flow of money. And before we see some data that comes out, before we hear Warsh in his new position, I think that there is going to be, the market is just going to be a little bit volatile, and nobody's going to have a reason to take a lot more risk or a lot less risk unless the geopolitics change.
So then we'll look forward to the next earnings cycle. Hey, Michael, come on in. So I do interesting, meaning interesting, possibly a recession here, or is that crazy considering all the dynamics you guys just laid out in terms of the U.S. economy?
I think in general, if we are going to get better productivity, an AI boom that pushes up corporate profits, then risk assets will hold in here. Risk assets, it's remarkable how well they're holding in. And again, I'm having flashbacks to the summer of 2007. They held in for a while. Don't forget, in 2007, the stock market didn't hit a record high until October 31 that year. And the Fed had already started cutting rates because Countrywide was being frozen out of the repo market for this mortgage book. So there were tremors going on, and obviously we've had issues with private credit this year. We've had some concerns that maybe layoffs are coming through AI.
Right.
But I think, again, this is what investors are having to grapple with. There's just so many moving, and you have the Middle East situation, which is really... again, historically, the U.S. economy goes into recession because of oil shocks.
Well,
we haven't quite had oil shocks, I guess.
All right. We're going to leave it on that note. Michael Mackenzie, Bloomberg News rates reporter, Alli McCartney here in studio, private wealth advisor, managing director, wealth management with UBS Alignment Partners. Guys, thank you so much. We're going to talk some real assets when we come back.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower, the stocks higher. Semiconductor dip buyers step in. The Dow, the S&P, NASDAQ all remain in the red, but we are off session lows. 20-point drop on the S&P right now at 73.82, down by about 0.3%. The Dow lower by 110, down 0.2%, while the NASDAQ Composite Index is down 104. For NASDAQ, a drop of 0.4%. The SOX, the Philadelphia Stock Exchange's Semiconductor Index up now by just about 1%. We've got the 10-year at 4.65% with a 2-year 4.09%, and right now the 30-year is at 5.16%. Spot gold down 1.5%, $44.98 the ounce, while West Texas Intermediate crude down 0.7%. WTI 107.83 a barrel on WTI. Brent 110.64, down now by 1.4%. Doug Ostrover, the billionaire co-founder of Blue Owl Capital, is unloading his stake in the NFL's Washington Commanders. Sources tell Bloomberg Ostrover is selling his stake back to the Josh Harris-led ownership group. And the Super Bowl will be heading to Nashville for the first time. The game will be played in Nissan Stadium, a new facility scheduled to open for the 2027 season as home of the NFL's Titans. Recapping, S&P 500 index down 0.3%. The SOX higher by 1%, and West Texas Intermediate crude 107.90 a barrel. The 30-year 5.17%. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Hey, last month, Bloomberg out reporting on Las Vegas, noting that business on the Strip has cooled as tourists are deterred by rising costs, including parking, resort fees, and higher prices for food and drinks. But I'm really curious about what our next guest has to say.
Wouldn't that be everywhere?
I know. Well, they decided to, focus on Vegas.
No, but I feel like costs are going up everywhere.
They are. Yeah. But I am curious to see what our next guest has to say, because they've opened the Fontainebleau Las Vegas, or as you said it, much better than I did.
I did not say it well. That's why you're saying it.
The $3.7 billion property, it opened in late 2023. Let's get to it with Brett Mufson. He is president and partner at the vertically integrated real estate and hospitality group. It is
Fontainebleau Development.
Fontainebleau Development. Yes. I want to make sure I said it well. They've been involved in more than 100 plus real estate projects and developments worth more than $27 billion in transaction value. And you guys play across the spectrum. Welcome. I warned you that we're in a little bit of a crazy way today. How are you?
I'm doing great. Thanks for having me.
It's good to have you here. You do a lot in Miami. You do a lot in Vegas. Are those the two places where you see the most opportunities? Because you can play everywhere and anywhere, and you do.
We do, yeah. I think, for our investment thesis is kind of investing, thinking about a paradigm shifts in our business. And what I mean by that is Fontainebleau, large-scale luxury resorts kind of span different income streams, so retail, entertainment, groups, leisure. We span kind of the tide of all of it, right? Nightlife.
Maritime. Wellness, you guys go everywhere.
We touch it all, yeah. So I think that those two markets clearly have the diversification of consumers that we can address, and we've had a lot of luck doing that in both markets.
What do you make of Carol's opening about the focus on Las Vegas and the softness or the cooling that some people are saying we're seeing as a result of higher fees?
Yeah, I think that, listen, in 2025 was clearly a year of normalization, right, after two record-breaking years in the prior years. So I think...
You mean coming off of COVID?
Coming off of COVID. Yeah. It's a normalization, I think, that we've experienced in 25. In 26, though, if you look at just the calendar, it's incredible to see the demand, right? So LVCVA, which is the Las Vegas Convention Center Authority, they've announced that 2026 may be a banner year for meetings and groups. That's huge for our business, right? Consumer spending, yes, it's up, just like you said earlier, across the board. But there's been a clear bifurcation in the marketplace. It's a K-shaped economy, as a lot of people are talking about, and we have fortunately built our product purpose-built for that luxury consumer.
So, how much pricing power do you have at the higher end?
We're seeing a lot of pricing. I mean, for us, listen, it's a little bit different. We're in our early years of growth, so every year we're growing year over year. The market, if
double digit
growth,
high teens,
yeah, about 18% in the first quarter. But if you look at our competitors, they have flat growth, even with visitation being flat, right? And so I think that just means that spend is staying pretty consistent. I mean, there's about 23.8 billion of revenue, across the Strip in Las Vegas. It's a lot of money, and it's about 6 billion, which is about 36% increase since pre-COVID levels. And so with that, though, you see, there's a clear bifurcation, and we happen to be continuing to grow. And it's the the numbers and the proofs in the pudding with the numbers. People are spending more per visit, right? Even with flat visitation across the board.
Brett, you mentioned convention. I mean, we're going to be headed out to something in June.
I think we still have to buy the tickets.
Yeah,
but yeah, we're
but
going.
And then yesterday
Well, I
we
hope you're
talked.
staying with us.
Dude, I don't even know if we have our tickets. Listen, there's a lot that we have to figure out today.
But we were talking to a colleague who was out at Dell World, which was in Vegas. Like, how much of your business, like you guys, rise and fall based on convention activity?
Yeah, it's about 50% of our business.
Okay.
Wow.
And by the way, that spans also in Miami as well. I mean, that's our bread and butter.
So when that's your business, do you find that individuals are paying or companies are paying?
So it's the wallets for a convention spender are, if not better than, depending on the group.
Yeah.
Right. So it all depends on the quality of that group. But if you get the right quality, which is where you work on your patterns and finding the right groups, then yes, it could be better than a.
Well,
than
the reason I ask is this is like we're hearing more and more about people going on. It's called bleisure, I think. It's like business / leisure. So they go somewhere for work, but then they stay a few extra days because they like where they are, and it turns into sort of a mini vacation. And is that a big opportunity for you?
Yeah, absolutely. I mean, we listen. At the end of the day, it's as you know, we're in a screen economy.
Yeah.
Right. And so our thesis around all of this, and this goes to groups where people need to meet to make deals, for example. Right. They can't do it behind a screen. Or if it's nightlife, which is an experiential experience, right? So people are enjoying that, or just food and beverage and getting in front of people and being, human.
How big
right?
of it?
I think that's a big deal in today's environment.
How big of a driver is in Las Vegas, at least for you at Fontainebleau, is the Sphere and people coming to see stuff at the Sphere?
We've seen a major uptick in our customers actually. Combining they're visiting us because of the Sphere.
Yeah.
There's no doubt.
You talked to, I've talked to so many people. We've been out there since the Sphere was there.
We kind of keep hoping for a 24-hour so we can actually go.
I don't know. How much do you like fish, Carol?
Yeah, exactly.
Big fish head over here. So maybe, I think they're done
We
now.
tend to do a 24-hour trip when it comes to Vegas. When you look at real estate generally, though, before I get into like areas and stuff, the rate environment, how is that making certain projects more attractive, or are you holding off in hopes that it changes maybe in the next few months?
I think it's a double-edged sword, right?
Yeah.
I think new projects are very difficult to get built. Interest rates don't make that easier. But on the other side of it, we were very fortunate to own an asset that we got built in a market that had zero supply in 15 years.
Yeah.
So that's helpful, right? Barriers to entry are higher for us. But yeah, there's no doubt, there's no hiding it that rates are higher than they have been in the past, and I think that's kind of fed through the food chain, so to speak, and that's why you're seeing consumer pricing kind of matching that, right, and offsetting that for owners and operators.
Brett, is it making you guys say, let's just hold off on this project, let's just kind of wait and see where the dust settles, or no? Are you still saying we want to do this? The market looks good, the opportunity looks good. Let's do it.
We play in a premium luxury customer space. And so when you're in that space, in a K-shaped environment, which we are in, which I think is going to have, no stopping in the foreseeable future, we think that you can still build to that customer, but it's not without challenges.
Where else do you go to build?
Well, we've historically we've been in Miami. We have two large-scale hotels there. The Fontainebleau, obviously, in Miami Beach, and then we have Turnberry Isle Resort and Club, which is in Aventura. And then we also have a hotel in Nashville, actually, Hilton Nashville, which is right in the center, right in the downtown.
Everybody loves Nashville, man.
It's a great city.
But what about expanding beyond where you already have a presence?
Yeah.
What are the markets that are attractive to you right now?
Well, our pipeline is actually pretty robust. We're looking to expand the Fontainebleau brand across the globe. And no better place to kind of launch it than moving it from Miami after 70 years of history, moving to Las Vegas. And so that was our second entree, and we plan to expand our presence in Las Vegas and then beyond. So we're looking at markets like the Middle East and Dubai. We look at Asia markets, and across the country.
Does the war in the Middle East make you think differently about that as a region?
It makes you take a pause, but at the same time, I think that it's a short-term situation that they're in, and there's a lot of growth going to happen there, and we're believers in that long term.
Apart from those international markets, what about additional U.S. markets?
Any market for us that has the ability to capture large-scale resort product, which is unique, right? So we need to be in the markets that have enormous group demand, that have an appetite for nightlife, right? Big food and beverage presence. Our skill set is in the lifestyle and luxury resort, but in large scale where you have meetings taking place as well. It's very
New York.
there you go. New York could be on our horizon. I was here for 15 years, so that would be a dream.
Is it? Is it on the horizon?
Not yet, but
Okay.
hopefully.
Well, we talked about coming in, just all the different things you guys do: hospitality, residential, commercial, aviation, gaming, culinary, maritime, and more. Wellness too. I mean, is the growth area really hospitality? Is that where you guys get the most bang for your buck, or
It's
no?
it's across the board. Vegas is a diversified demand, environment.
Yeah.
So is all of our resorts, for that matter, just given the diversity of what we do. But Vegas in particular, they did an incredible job making it the entertainment city of the world, right? The capital of the world. So for us,
It's gone through so many iterations. Remember when it was supposed to be like, bring your family, it's for the family, and then it's kind of gone
There's
back.
still a lot of families who
but you
go.
No,
can
I
still do
know,
it all.
but-
You really can. We have the Sphere is another example of it
Yeah.
reinventing itself. Allegiant Stadium does incredible events with the Raiders. VGK has an enormous fan base locally, right? You can't forget that the town has really gone from a gaming town to an entertainment business and infrastructure.
Is Florida getting crowded?
Florida, absolutely. There's been a massive amount of growth.
Yeah. Is it less opportunities?
No,
or
in fact, I actually think there's an enormous amount of demand, and the future is bright for Miami, especially South Florida, and I could go on and talk about all the different firms that are moving down there and moving their offices from New York, and we've been the beneficiary of that in the hospitality space.
Anything out there give you pause right now?
Great question. No, I think, listen, the only thing that gives you pause, at the end of the day, the consumer is hurting.
Yeah.
Right? And we all see that. So, as you invest, we invest at the high end, so we're lucky and fortunate to have that. But
Well, what is the typical profile of your customer?
our customer spends about 2 trips a year coming in and out of Vegas. They got about $150,000 of net worth. On average, right?
Okay.
We're talking about averages, not the aspirational
Yeah.
level.
Yeah.
So we're very focused on the data and having oil prices where they are and other things. Travel's down, right? Visitation's down, but at the same time, you hear the Delta CEO talking about how 60% of its revenues are coming from the premium cabins. That's our business.
Love those premium cabins. I'm just going to put it out there. Who does it? Who does it?
Again.
No, you talk
It's
to the airlines, right? They
companies
just keep
paying. And the companies are the
expanding.
ones paying, so
I
there's a high
know.
willingness
Right.
to pay on that part.
Brett, this was great. Come back.
No, I appreciate you guys having me.
Yeah.
Fun chat.
Thank you.
Appreciate it.
Brett Mufson, he's president and partner at Fontainebleau Development, joining us right here in studio. When we come back, we talked about real estate, a hard asset. We've got another one. We're going to talk diamonds, those grown in a lab. We've got the founder of Astrea London. That's next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks lower, and the latest bout of weakness in bonds is lifting yields to multi-year highs. S&P right now down 28, a drop there of 0.4%. Dow Industrials down 177, down 0.4. Nasdaq down now by 0.5%. But on an down day for much of the market, we're seeing an up day for the stocks. The Philadelphia Stock Exchange's semiconductor index dip buyers coming in. The SOX now up by 0.8%. The 10-year at 4.66% with the 2-year 4.11%. The 30-year 5.17% right now. Multi-year highs. We have got spot gold at 4,500 even the ounce, down 1.5%. West Texas Intermediate crude 107.77 a barrel, down 0.8%. Barrel of Brent just above 111 right now, down by about 0.6%. Bitcoin, meanwhile, down 0.1%, back at 76,750 on Bitcoin. 8,000 job cuts at London-based Standard Chartered, with CEO Bill Winters warning that a push into AI will replace, quote, lower value human capital with technology. ADRs of Standard Chartered, they're down 2.7%. I mentioned oil selling off today. WTI again down 0.8%. Oil majors are higher. ExxonMobil up 1.3%. Chevron now up by 1.4%. ConocoPhillips up by 0.6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City. The global lab-grown diamond market valued between $26 and $30 billion. We've reported this across Bloomberg. The synthetic segment now accounts for over 50% of all engagement rings. Surging volume and falling prices have severely disrupted the $80 billion traditional diamond industry. And I got to say, you walk into any jewelry store. I have a jewelry store that my mom went to, we grew up with, and it's like mined diamonds, real diamonds, I guess you should say, synthetic diamonds right next to it. And then you've got like CZs and some other things. But it's just amazing, the category, when you go into a jewelry store.
I wonder if Nathalie Morrison is going to take issue with the word real that you used just
I know.
now.
That's why I hesitated.
She is the founder of Astrea London. The brand, by the way, counts Sarah Jessica Parker as its global creative director. Nathalie, welcome. Make the point for us, though, this sort of distinction or no distinction between a lab-grown diamond and a diamond that's mined in the quote-unquote traditional way. Is there a difference?
No. There is zero difference. Chemically, optically, structurally, it's a seed of carbon who all grows under the ground and take billions of years to get up to the surface and a lot of money and deforestation and time to extract versus putting it in a microwave. But it's a seed of carbon.
But if I take
baby at the end.
If I take one lab-grown and one mined diamond to my friend Brian's dad in Midtown, who's been doing this for 40 years, can he tell the difference between the two?
No, because there is none. There's no gemologist in the world who can see the difference between a lab and a mined diamond. Do you know, I often made a really bad analogy, but it's a little bit like IVF versus an IVF baby. I've got 4 of them. Trust me, they're all the same.
Well said, well said.
All right.
I thought early on when they started doing lab-grown diamonds that there were limitations in size. But tell me, is that not the case? Can you do anything in terms of size, shape? You can do anything.
The more technology advance, the less any constraints we will have. But there is no limits in anything, in color, size, quality. I actually believe today that the quality of lab-grown diamond are superior, especially on the very high end of the diamond market that we are in, that we can find in the mine.
Do you make them like, I think about, what is it, the 4 C's or whatever? Like, do you just make what's grown in the lab? Are they all just the top of the tier, if you will, in terms? No. So you do make different, yeah.
That's correct. So any diamonds come from the level of money, investment, quality of the reactors we have, technology behind it. So no diamonds are the same, whether it's a mine or whether it's a lab.
So what is the technology?
So there is 2 types of technology in order to make them. So as I said earlier on, it's a seed of carbon.
Yeah.
So basically, the carbon is the strongest material in the world, right? And which you put in a reactor, and we basically replicate what happened under the ground in those reactors with 2 methods called CVD and HPHT.
So pressure.
One is the pressure intensity, one is replicated through the heat.
Okay.
And by doing that, within 4 to 6 weeks, a diamond is formed.
4 to 6 weeks. How much energy does it take?
Okay, so that's an interesting question, because the biggest challenge at the moment is, 1, the resale value, and 1, the sustainability, which are the main question. Because it's no more a secret that a diamond is a diamond, whether it comes from a lab or a mine. So now the 2 challenges in terms of education we face. Coming to energy. Obviously, it takes less energy in a reactor than under the ground. So the reality is it takes a fifth less, approximately, in a reactor than under the ground. However, it's not 100% sustainable yet. I actually don't believe it. However, it's improving every day with technology, with renewable energy, with using, so today we only use recycled gold. So everything is improving all the time. We don't use water. There's no deforestation. There's no human traffic problems. So there's no many problems that we can talk of.
I know, though, before we got going, we talked about the impact, certainly, on the economies that have depended on mining. And I guess it's safe to say that, I don't know, is that the downside of all of this,
Yeah, sub-Saharan Africa, like Botswana, for example. Jen Jabasaja was here talking to us about that just a few months ago.
Exactly. So there is that downside.
Yeah, it's correct. It's correct that the Botswana economy has relied for years and years on the mine industry. But actually, the world is evolving through technology, and I think countries need to adapt. I think we do need to help those countries. So Astrea, for example, will give a percentage of their income for giving education to kids in Africa. And I think a lot of companies should do and help anyway, in general, in the corporate world. However, the mine industry, if you look at it today, also have given a lot of the percentage of their mining result to De Beers. And I think today they are potentially buying out De Beers or a part of it. So maybe it's not a bad thing for anyone. The world needs to diversify, and the economy of each country needs to diversify.
I want to talk a little bit about what took so long technologically for us to get here, because I mean, you know, it was almost like I got engaged a decade ago at this point, and this wasn't even a thing. Like lab-grown diamonds were not even part of the conversation. I talk to young people today, and it's like,
For your wife to be, or just were they around?
So the lab-grown diamond have been around since after the war in 1950. They were actually made.
but they weren't.
But they weren't really.
It was
they
not
were not
prevalent.
known.
Yeah.
So out of the diamond market, lab-grown diamond was 1% of the market in 2015.
Yeah, that's
20.
Okay, fair.
Yeah, 5% of the market in 2021. 40% last year. 70% of the engagement ring of the US today are lab-grown diamond. And The Economist is expecting it to be 75% by 2030. I actually think it will go faster than that.
yeah. So
Wonder
you're illustrating my point perfectly. Why was it such hockey stick growth, and why did for so many years was it under the radar?
Well, the reality is the mine industry has been dominating the industry, the diamond industry, for 100 years, and have done an amazing exercise of marketing with De Beers. First of all, telling us that the diamond is rare. Diamonds are not rare. The reality is there is enough diamonds in the world so that 8 billion people can each have half a carat each, and you will still be having hundreds of thousands of them being hidden somewhere. So the reality is the diamond is not rare, but they've done a beautiful marketing exercise in order to promote it that way.
Why are diamonds still, though, then so expensive? Like, if so many people are choosing for engagement rings to do lab-grown diamonds.
I mean, the lab-grown diamonds that I've seen have not been expensive relative to
because what's the cost?
a mined diamond.
What's the cost differential? Like percentage?
The difference of price is I'm out.
You're good.
Oh, you're good. You're
Yeah,
doing
don't
Okay,
worry.
so the difference of price is approximately 70% between a lab-grown diamond and a mined diamond.
70% cheap, less expensive?
Cheaper.
Yeah.
Lab-grown diamonds are cheaper by 70%. First, it costs less to make them. You don't have to extract everything from the planet. You don't have things. But you know, the real question today is actually the resale value. The biggest, I will say, problems between lab and mine diamond is they should work together. They should work together instead of fighting. Yeah. The biggest critiques that mine diamond gives to lab-grown diamond is, there is no resale value. And I always say, yes, obviously, you may have no resale value, but there is a resale value to everything. So let me give you an example.
Just got about 25 seconds.
If you get 2 carats of lab-grown diamond today, you will probably, in D color, which is the high end what we do, it probably will be $6,000. The same equivalent in mine will be $60,000. By the time you leave the shop, you've already lost $30,000.
Yeah.
So personally, even if I lose everything, I know what I want to buy.
I'm just going to take this and just show it to my husband at home. Nathalie, thank
He's
you
watching.
so
He's watching. It's
much.
fine.
Nathalie Morrison, she's the founder of Astrea London. We'll get you back soon. When we come back, we talk stocks on the move.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, getting ready for the kind of moving in very close to the last hour of trading.
You're getting ready
Tuesday.
to get out of here.
I am. I'm jumping on a plane. Got a little work assignment to do.
I'm very excited about your work assignment. I'm not going to tell everybody what it is because it's top secret under
My
wraps.
lips are
But when
sealed.
can we see it?
I think it's going to come out in July or
Okay.
August. Yeah, I think it's going to be
That's
summer
called
thing.
a deep tease.
Deep tease.
The only hints you get are Carol's gone for the next couple of days, and she's taking a plane there,
I'll see you on Friday.
and you're taking a plane back.
I'm leaving.
Yeah, okay.
on a jet plane. Nathalie Morrison was just with us, founder of Astrea London, and she mentioned something about what's going on in Botswana in terms of diamond mining, and she had said human trafficking, but she meant really human rights. So we just wanted to clarify that for those who were listening. Interesting conversation, though, the change in the diamond market. And I said, I feel like I go to a store and I still feel like real diamonds, forgive me, not lab grown, are still somewhat expensive considering, right? Yeah. Avalon's nodding her head. She's going to come in just a moment.
They are, but
I know they've come down.
The prices have collapsed as a result of.
But you go to a jewelry store and they're still a lot more expensive than the lab grown.
Yeah, I mean, I'm looking at the diamond index right now on the Bloomberg terminal from highs of back in 2011. Down 67%.
Times have changed,
Yeah.
certainly when it comes to the diamond market. Same, too, when it comes to live golf, and we've been covering this pretty extensively. Remember when this was created, kind of a go at the establishment, if you will, in terms of golf, but Live Golf said to be ready for a U.S. bankruptcy if it cannot raise funds. And we know it's been very much backed by Middle Eastern investors, and I think they have gotten to a point where they're not necessarily looking to put more money in.
Specifically Saudi Arabia's Public Investment Fund. And when they pulled the plug, as we spoke to, I believe, Randall just a few weeks ago, a lot of people thought it was sort of like an endless supply of money, and they're pulling back a little bit.
I think everybody thought that it was going to be a challenge to the PGA and so on, but it's not necessarily playing out that way. Anyway, it's something we're going to keep an eye on for you. And just a quick headline.
They said potential bankruptcy too could come after the season, and this is a U.S. bankruptcy. After the season,
a U.S. bankruptcy. Yeah. All right, keeping an eye on that. Also keeping an eye on the markets for you. We are off our highs, off our lows. We're down, though, across the board when it comes to the overall indices. S&P, Dow, and NASDAQ 100 are all down. Let's take a look at some stocks on the move. I'm Carol Master along with Tim Stanovic. Let's get to Bloomberg News equities reporter Avalon Purnell here with stock movers, unless you want to talk diamonds.
Maybe we could do both.
Maybe we could do both.
In all seriousness, though, just real quick on diamonds, and then we'll talk stocks. Have you noticed that, everybody is doing lab-grown diamonds now?
Yes.
Yeah.
Yeah. No, it's very popular, especially on TikTok. You can see different resellers.
So
much has changed in such a short time.
I know. It's pretty amazing. I think about when I got married and we went to the Diamond District and you pick out a stone and then you have a ring, right, built around it and stuff. But it's very different today. I don't know. It's pretty interesting. I like the idea of it being less expensive.
Should we go from diamonds to
pets?
Pets.
Yeah. Okay.
Yes. We can go ahead and get started with Chewy. That's ticker CHWY. It's currently falling about 9.1% today to hit its lowest intraday level since 2024. And that's after the pet foods company CEO offered some fairly cautious commentary at a JP Morgan conference earlier today. He said that while the company still expects its pet segment to remain resilient, the company is seeing a more stretched consumer currently. And I feel like that's been the type of thing that we've been hearing from a lot of consumer companies lately.
Yeah, we're not buying as many toys. They definitely get their food and they get their breath fresheners and that kind of stuff. But puppies, here's a stick. I'm just going to say they're well loved. Let's move on over from dogs to DoorDash.
Yes, that's
keeping us fed.
Exactly. It's also falling about 3.9% today. That's after Business Insider reported that Walmart's Spark, which I wasn't previously aware of, it's their delivery service, is now delivering food from restaurants like McDonald's. So the delivery space has been really competitive with Uber Eats, Grubhub, and now Walmart is also stepping in. So investors are a little bit curious about what exactly that will mean for companies like DoorDash.
Yeah.
I didn't know about Spark Driver.
This was news to me today as well.
Maybe not as big in New York.
That makes the three of us, right? Yeah, so maybe it's just elsewhere. Let's go to a name we don't always talk a lot about, but the ticker is RLAY.
Yes, Relay Therapeutics. A much more exciting move earlier today. It's now only up about 0.8 of a percentage point, though earlier it was up as much as 13%. That's after the drug maker released data from a mid-stage trial that was quite positive, showing that its experimental drug seems to be helping those patients that have a rare genetic disorder that impacts their blood vessels development. TD Cowen writing that the update is a home run and that it could actually mean that there is a new opportunity for this drug to treat a very lucrative market.
All right.
So 2 decliners and a gainer.
Yes.
All right. There we go.
Are you feeling kind of down today? So going more decline.
There's so many decliners in the market.
I know, and that's what's frustrating to me is that I'm on gainers today, and I got no good stories.
I'm so sorry.
It's okay.
Yeah.
It's okay.
All right, well, that's going to do it for the first hour of Bloomberg Businessweek Daily. Our thanks to Avalon Purnell, Bloomberg News equities reporter with our Stock Movers segment. You can check out our Stock Movers podcast. They are 5-minute episodes, biggest winners, biggest losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
I'm bidding you bon voyage, farewell.
So long, farewell. The
second time we've heard from Carol Master singing today. That's pretty great.
I know. I know. Sorry. I'm so sorry. Everybody.
Have a wonderful trip. You've got to jet out. Alexandra Semenova is stopping by for the next 2 hours. She is filling in for Carol. We got a great program coming up. We're looking forward to that. We're actually talking chips right off the top.
Chips?
That's next. Yeah, not the type you eat.
Chips?
Sorry.
Oh, got it.